Steve Paulson here, founder and CEO of Open Market CRE, welcoming Jordan Kanter of Victory Financial Services. Jordan, thanks so much for joining us today. I think we're going to have a pretty thought-provoking strategic conversation around a very good tax strategy.
Great, Steve. Thank you. I'm happy to be here.
Yeah, great. So, one of the things that we always face in the commercial real estate world is everybody wants, some sort of tax strategy. They're looking at, 1031 as being a really main tool. Obviously, it's been around for over 100 years, and depending upon the political winds, it's either in favor or out of favor. And obviously, 45 days to identify really is a challenge for us as commercial real estate brokers because, you really only get one good, clean shot at it, right? I mean, when due diligence is running, 15 to 45 days, you come into all sorts of problems, right? Title issues, lending, appraisals, environmentals. I mean, there's all kinds of surprises that can derail a deal. So me internally with the team, we kind of went down the rabbit hole of, are there other options, right? I mean, are we pigeonholing ourselves just to this one solution, right? And so we kind of stumbled across your group and, a deferred sales trust. I know we call it the DST, but, not to be confused with that Delaware statutory trust. This deferred sales trust seems to be a pretty good solution. And we wanted to talk about it today. Why don't you tell us a little bit about yourself, Jordan, and what your offerings?
Sure, Steve. Again, I'm Jordan Kanter. I'm the principal trustee for the company estate planning team. Victory Financial Services is my company, which acts as one of the third-party trustees on these transactions, which is really critical to making them successful and compliant. I've known you for a long time, and I know that you deal quite heavily, if not exclusively, with multifamily transactions. And certainly 1031 exchanges are and have been a pretty significant portion of that industry. And a lot of people, I assume almost everyone, if not everyone listening to this presentation is familiar with 1031 exchanges, as you said. And I just want to point out a Delaware statutory trust, as you said, which is the other DST, is a 1031 exchange replacement property. The DST that we're talking about today is the deferred sales trust. This is a transaction type. It is not a type of property. It's a tax deferral structure. We were actually the first. So the confusion in the acronyms came when they created Delaware statutory trust. But we've been there for a long time, which is a topic I'll touch on later. This is not a new structure. This is not something that somebody just thought up. We've been doing this for almost 25 years. There have been thousands of these transactions done, these deferred sales trusts. It has a 100% successful track record, even under audit. In all those thousands of transactions, it's been audited probably about 20 times altogether, and every one of those audits was dismissed without change. So this is a structure that's been tested. It's not flying under the radar. It's out in the open. The IRS knows that we're here. We do things in a very compliant fashion. We do things responsibly. We don't deviate from the things that we need to do, and that's how we've been so successful, in addition to it being quite a brilliant structure. So let me just give you briefly what the deferred sales trust is. So as I said, the deferred sales trust, like the 1031 exchange, is a mechanism for the deferral of capital gain taxes and straight line depreciation recapture, just like a 1031 exchange. There's a few critical differences between a deferred sales trust and a 1031 exchange, which are very important and very appealing, particularly in a market where it's very difficult to find replacement property that you want to acquire and identify it within 45 days and close on it within the balance of 180 days. The most significant difference, I think, for our purposes today is that there's no like-kind property requirement in a deferred sales trust. In a deferred sales trust, you can sell your multi-property real estate, multifamily, I should say, or multi-property, whatever you're doing. And you can use it as an exit strategy from real estate, or to diversify your holdings, or to take a temporary pause from real estate, because you don't have to go from real estate and immediately back into other real estate. You can sell your real estate and have the funds go into an account, a brokerage account typically for the trust that's set up exclusively for you. And those proceeds can be invested in just about anything. So If you're looking to retire, for example, they can be invested in a portfolio of stocks and bonds and ETFs, potentially annuities, even REITs, which are not qualified property in a 1031 exchange if you want to maintain some purely liquid real estate holdings in the deferred sales trust. But it's really a way to achieve liquidity and diversification and have the pre-tax proceeds working for you rather than take that capital gains hit and take a step back, as is the case and the goal with a 1031 exchange as well. Don't get me wrong. I've been in the tax deferral business for about 30 years, and I've done many thousands of 1031 exchanges. So if it's a situation where there is a property that you really want and you can identify it, and you know that you're going to be able to close on it, that probably is the right situation for a 1031 exchange, at least in part, because you know that's what you want to do. But in situations where that's not what you want to do, where you can't do that, where you can't identify property, can't close on it, where you want more diversification, where you don't want to be dealing with the ongoing day-to-day responsibilities of real estate, that's really what a deferred sales trust is for.
Well, I'll never forget about it. 18 months ago, I had a client tell me, well, if I think about liquidating the real estate, I'll just go into treasuries. And I said, oh, never heard that one before. So
Yeah.
It sounds to me like the deferred sales trust from a diversification standpoint really allows you to deploy that money and investment capital into a lot of different, kind of investment vehicles. Is that correct?
Yeah, and what you just that example you just gave is actually a fairly common one. What that indicates is someone who wants to exit real estate ownership and keep their money, the pre-tax proceeds, working for them, but in a relatively risk-free way. But that's usually what it means when somebody wants to go into treasuries, and certainly in the current economic environment and the interest rates that we can get on treasuries now, that is certainly an option. That's a very conservative one. If there are occasionally people who do that, most of the time they'll diversify some of the assets into something other than treasuries, but that is actually something that can be accomplished, what you just said. And the beauty of it is that by leveraging the pre-tax proceeds, you're able to invest the money into something that isn't extremely volatile or risky, but you get a higher rate of return overall simply by having more money working for you, just like you would, as I said, in a 1031 exchange, because you retain the use of the pre-tax proceeds. If you put them into something like treasuries, right, let's say conservatively speaking 4%, well, that's kind of like a 6% pre-tax return. I mean, that's kind of like, if you're comparing the apples to the oranges, if you have pre-tax proceeds and you invest them in something like that, you can get a higher rate of return for yourself, either temporarily or in retirement, right, without having to subject the money to substantial risk. If you want to be more aggressive and, not even extremely aggressive, just more of a moderate blended income growth type of portfolio, like a financial advisor would, typically designed for someone, you can do that as well.
And what happens to this 45-day identification period and all in 180-day to close? What happens to those time periods in a deferred sales trust?
Yeah, so that's another great question. And that's the other really significant difference. I think there are many, but I think that's the other really significant difference to highlight between a deferred sales trust and a 1031. The other one, which we may not get to, but I just want to make a quick note of it, is that you can split up entities, partnership entities. A lot of people who've done 1031s over the years know that with entities, generally speaking, to be safe, everyone has to continue and complete the exchange together. You don't need to do that most of the time in a deferred sales trust. You can go your separate ways from your partners, your family members, whomever it might be. And you can each have your portfolio managed according to your own risks and preferences. So that's just something I wanted to throw out there. Did you want to follow up?
Yeah, I love that part of the structure, right? Because, in a lot of cases when you do have partnerships, at least, as a boots on the ground guy, it pretty much, like you're going to have to deal with your taxes on disposition if you're not going to keep that same corporate, configuration. So
that's right. At least not right away. Because sometimes the sale will come up on you when you're not expecting it, or your CPA hasn't suggested preliminary steps to take to be able to do tax deferral individually. So this is certainly something that could be done. And in the spirit of just answering the question you asked, rather than the one that I chose to answer, you were talking about the 45 and 180-day rules, and that's the frustrating part of 1031 exchanges for most people. It's difficult. Those are unique to the 1031 exchange structure. Where the 45 and 180-day rules come from is the Treasury regulations on 1031 exchanges. It's unique to 1031 exchanges. The deferred sales trust is based on section 453, not section 1031. So there is no 45-day rule. There is no 180-day rule. There is no like-kind property requirement. There is no same taxpayer requirement, aka entity split-ups. You can do tax deferral through a deferred sales trust without any of those 1031 exchange constraints. They're not. In fact, another one. I always, when I talk to you, Steve, I always have a lot of brainstorming going on because you ask such good questions. But another feature of the 1031 exchange people are generally concerned about is the debt replacement, right? The debt replacement requirement. There is no debt replacement requirement in a deferred sales trust. The pre-tax proceeds end up in the trust if it's done correctly and in a timely manner. You don't have to replace the debt. The only concern with debt is that if the debt exceeds your basis, your tax basis, then there's some additional planning that we might need to work around, because mortgage debt over basis is kind of not the friend of the 453 structure. But generally speaking, the point is that you don't have to replace that debt. You can get the cash out on a pre-tax basis and put it to work for you.
Well, the good news is I'm smart enough to know that I should always contact my absolute trusted advisors and experts. And so that's why I lean on you for such enlightening information. I'll tell you, it's a little bit above my pay grade, but I love sending people your way, and you can certainly get pretty granular, I'm sure, with an entire team of advisors. So as far as the deferred sales trust goes, there's this installment sale portion. What is that? And can that installment sale be, kind of redeployed within the trust? I mean, talk to me about the mechanics of navigating that
Sure.
Installment sale.
Let me just hit that point you made about the trusted advisors. This is we're a very open organization. We want people to bring their advisors onto the calls where we can talk about it with you and educate you on this. There's a lot of confusion about what a deferred sales trust is. There's a type of structure out there recently called a monetized installment sale, which was cracked down on by the IRS not too long ago. And a lot of people started thinking that's what we do. That is precisely what we do not do. We didn't do it. Years ago, when we were competing with companies offering monetized installment sales, people asked us to do it, and we wouldn't. And I'm not going to get into exactly what that is, but if you talk to your advisor and they say, oh, this is just a monetized installment sale, it's not. Invite your advisor onto a call with us. We'll make everyone comfortable. We're very low key, as you know, Steve. We're just information providers, and I'm sure you'll be satisfied, and they'll be satisfied once they have the opportunity to talk to us. So, as far as your question goes, what was it? I took a detour.
The installment sale portion.
All right. So, actually talking about a deferred sales trust now.
Yeah, that's right.
Okay.
There's so many different vehicles out there for this stuff, and it can be a lot.
Yeah. So what the deferred sales trust essentially is, there's a few variations on the deferred sales trust, but the most commonly used one is often referred to as a structured installment sale. So if your CPA or your attorney doesn't know what a deferred sales trust is, they may know what a structured installment sale is. It's a type of installment sale that's created, as I said at the beginning of the presentation, with my company, which acts as a unrelated third-party trustee for your transaction. So what occurs is my company would buy the asset from you, right, for whatever the price is that you're selling it for. You have a buyer already. We're not, creating buyers out of the vapor. So you already have a contract. You've got a buyer who wants to buy the asset. There's a sale that takes place first. It's a sale from the seller, the taxpayer, to the trustee company, the third party purchaser of the asset. That is done on a 100% seller finance basis under Section 453. So what that means is that when you sell the asset to the trust, you're not getting the money back for the purchase. You sell it to the trust for $1 million, you're not getting that $1 million. The $1 million is staying within the trust, right? Because if you received it, that would make the capital gains and recapture taxable, right? The tax advantage to Section 453 of the tax code is that if you don't receive the principal from a sale, you don't pay the capital gain taxes on the portion that you didn't receive. That's how ordinary seller financing works. The next step is that the trust then sells the asset to the buyer, right? So what ends up happening is there's no taxation on the first transaction because it's a fully seller finance transaction. You get a promissory note back with some specified rate of interest based on your particular needs and preferences, right? And there's no tax on the second transaction because there's no capital gain, because the trust is selling the asset to the buyer at essentially the same basis as it bought it from the taxpayer, right? For the same price, adjusted, for costs somewhat. But that's how, at the end of the day, you end up with the pre-tax proceeds in the trust. And then there's a few steps that involve the financial advisor to the trust, where the taxpayer's risk tolerance is determined, their preferences are discussed, recommendations are made, and when everybody agrees on what the investments would be within the trust to generate that rate of return and protect the principal in the trust, right? For example, the person who would like the money in treasuries, after the taxpayer signs off on that, the money is deployed into the investments. If there's payments being made immediately, they're typically set up to go to the taxpayer on a monthly basis. There's an annualized rate of return. It's typically paid by direct deposit on a monthly basis. And the idea most of the time is for it to be interest only. So if you sell your asset for $3 million, and instead of getting $2 million after tax, you're getting $3 million pre-tax, that 4 or 5% from treasuries would be the interest payment that would fuel the note payment to you, the promissory note payment to you, and it would be a higher amount because you had more money invested in that safe asset. So that's essentially how the installment structure works. There is a promissory note. There is actually a buyer. It's an unrelated third-party buyer. That's critical to the trust structure, and that's essentially the basics of how it works. And even that isn't that basic, but that's essentially it. It's easier to flesh out the details more with actual transactions and discussions about what's actually going on in a person's particular situation than to sort of go more into the abstract at this point.
Sure. So you touched on something. You said financial advisor. I mean, talk to me about your team. Like, what does it really take to execute on a deferred sales trust? What does the team makeup look like?
Yeah, so the team makeup is, as I said, you need a third-party trustee, an unrelated trustee. It has to be one of the trustees under the fold of estate planning team. My company has done more than just about any company within this structure. So if anybody's, I'm not going to go into talking about myself or my company, but if anyone's interested, I can send them my CV. I'm an attorney. I've been in this business for 30 years, more than 30 years in some capacity doing tax deferral. I was a recognized figure in the 1031 industry early on, and I've been doing deferred sales trusts since about 2009, I believe. So, but estate planning team has been doing them for even longer, over 25 years, as I said. Also required is one of the tax attorneys who is knowledgeable and specializes in structuring these types of transactions. They're quite brilliant and quite affable, and people who are very good at explaining how the structure is going to work and what needs to be done, and getting an overall plan that'll work well for each particular taxpayer. There's also a financial advisor to the trustee. This is a financial advisor. It can't be your financial advisor. It has to be unrelated to you. It's the financial advisor to the trustee. These are people with a great deal of experience managing deferred sales assets, with a great track record of success, and who are certified to do this. The estate planning team is the umbrella company that basically manages all the relationships between these companies, and also enforces the standards. So there's training tools, there's an examination that needs to be taken, there's a membership to ensure compliance, and all of those sorts of issues. But you'll meet all these people if you're somebody doing a transaction that requires a deferred sales trust, or that you're interested in finding more about it. You'll meet all these people, and it's, as I said, it's a very open experience. We don't hide anything from anyone. There's certain proprietary information that we're careful about keeping private, but we invite your attorneys and your CPAs and anyone who else you feel might want to know what you're doing, and you're going to need them to help report the transaction anyway at some point. So it's a good idea to have everybody on board right away, and welcoming them in and communicating with them often avoids a problem of them feeling like it's a situation where there's something being done that's inappropriate, which it most clearly is not.
Gotcha. So how does an actual decision happen within the trust then?
A decision about the investment policy or the securities?
Yeah, like if they want to acquire something, or it's time to deploy some
Yeah,
capital.
yeah. So what I would say about that is, I actually stopped saying something that was related to that a little bit earlier. I should probably complete it. When the investment policy is created for the trust, nothing is done with the money without the signature of the taxpayer. The trustee does not just get a pile of money on his desk or her desk and does whatever they want with the money. It's not an absolute discretion situation. The taxpayer needs to agree. The taxpayer has to approve any investment that's being made in the trust and actually sign off on it. If the taxpayer has some preferences or recommendations or things that they're interested in, we talk about those. The trustee talks about it with the advisor and the taxpayer. Everybody comes to an agreement. Once the taxpayer is comfortable with the investments that are being proposed, they sign off on it, and the funds are invested in that manner. Until then, they just remain safely in the brokerage account.
I would imagine that is probably how a lot of trusts are set up and organized.
Yeah, to a degree. There's certain types of trusts that remove discretion from the beneficiaries. You're not exactly a beneficiary when you're involved with a deferred sales trust. You're actually a creditor, so you get the rights of a creditor and get to exert the protections and rights during the implementation of the trust. But you're right. Typically, I think the broader point, it's not an adversarial situation. We're all there to accomplish the same goal, which is to do well, to protect the taxpayers' money and earn a good rate of return on it for them.
Sure. And so for the estate planning kind of component of that, I mean, how does the deferred sales trust, what is the role in that in a broader estate planning, consideration where you're talking about inheritability and that sort of stuff? Can you touch on that?
Another great question, Steve. That's a really good one. That, strangely enough, that doesn't occur to people often until after the structure is complete, and then they ask, well, how do we do this? As I said earlier, there's a few different variations on deferred sales trusts for reasons that would just take too long today to get into what they are. But essentially, most of the time, it's the structured installment sale type of implementation where you get a promissory note, right? That promissory note is an asset. It's a debt instrument. It's an asset that you own. So you can devise that asset or dispose of that asset in any way that you would delegate the ownership upon your passing of any asset. So most often what we would recommend doing is, people generally have living trusts these days. If they don't, we recommend setting one up. It's not a very difficult thing to do. It's not terribly expensive. And you simply assign the promissory note to your living trust. The living trust specifies your beneficiaries. That avoids probate, and direct the ownership of the asset to your family members, your heirs, your whomever it is that you want that promissory note to go to. And remember, a debt instrument does not come due on death. It continues. It's an asset, right? Mortgages aren't forgiven when somebody dies. The family that inherits the asset has to still pay the mortgage, right? So if your heirs would like to continue receiving the payments under the promissory note on a pre-tax basis, just leave the trust in place. We would probably, in that situation, because they're younger, readjust the portfolio for their risk tolerance and the new investment profile. But that's typically how it's done. If it's not done in a living trust, it can be the promissory note can be devised in a will. You never want to leave any asset intestate so that the government decides who it goes to. But even that, I mean, it's probably going to end up most of the time where you wanted it anyway. It'll just involve more cost and anxiety for them. There's another type of deferred sales trust that's a bit different, but incorporates some irrevocable trust features into it. And those typically involve very large dispositions. In excess of 20 million, 50, 100 million. We do transactions like this sometimes for multiple $100 million transactions, right? And in those situations, it's hard to fit a transaction of that size purely into an installment sales structure in a single year. So we add some irrevocable trust features, and it accomplishes much the same thing, but you can do it with much greater amounts of pre-tax proceeds coming into the trust. The other really significant feature of those, though, that I should mention, if anybody's involved in any sales like that, is that structure will take your asset outside the taxable estate instantly. So there's no need for long-term estate planning and gifting and using up your unified credit and discounting and all of those typical estate planning features that can take a while. You can sell that $100 million asset, and that $100 million asset is immediately outside your taxable estate. And you know that's really, Steve, the big tax right there. We most of the time talk about capital gains, but the estate tax is the biggest tax there is. When you're above the exemptions, which I think are like 12 million and change right now, or 11 and change. So for a couple, it would be, $20 million and a bit. Once you're above that amount, you get into an area where you're taxed at 45% of the amounts over that. So that's a huge tax if you're an ultra high net worth individual and selling an asset like this. And this is a way to very quickly and effectively not only defer the capital gain tax, but move that asset entirely outside the taxable estate.
Interesting. And so as far as this deferred sales trust, are there any folks that maybe this is not a good fit for?
Yeah, I think there are. So typically, if you're not looking at about a minimum of $300,000 of tax liability, not capital gain, but actual tax liability, it's probably not worth it. The numbers tend not to make sense when the trust is that small. Also, we typically find that on very small transactions, things usually come up. These are not people with the biggest of cushions in their retirement, and often unexpected withdrawals come up and issues, arise that require deviation from the plan. And it's just not the best structure. This is really for stable wealth dispositions and an ongoing plan for tax deferral where there's a predictability to what you're expecting in retirement, or at least some predictability. I think also the other major group of people who I don't think this would be appropriate for is people who want to use this money for their own personal use. So if they're going to get $4 million pre-tax and want to spend their golden years traveling around the world and buying a yacht and getting a pair of Ferraris, and that's not really what a deferred sales trust is for. This is for money to be used for an investment purpose, a business purpose. Now, what you can do is within the deferred sales trust, we were talking earlier, actually, we started off this presentation, Steve, by talking about the differences with 1031 exchanges. One thing that is similar is that you can ultimately reinvest much of the proceeds into physical real estate assets if you want, or even a business enterprise. It doesn't always have to be securitized investments. Those are the most common for obvious reasons. People just want to live their lives, and if they can do it safely and get a better return, that makes them happy. Some people who are younger or just don't want to give up their life's work, you can reinvest back into those physical assets at some point. There's just a different way of doing it than in a 1031 exchange. And usually that involves setting up a separate entity where funds are invested as a joint venture opportunity by the trust. I don't want to get too involved in that because that can get quite detailed and confusing. I just want people to know that at some point, if there is a good investment, we can make that work as very simply one of the investments within the trust. It just becomes one of the investments, essentially.
And is there any sort of percentage requirements? Like if I'm selling my commercial real estate and I want to go buy more commercial real estate, I'm just trying to add some flexibility to my decision making.
Yeah.
Is there percentages or anything like that I should be aware of?
Yeah. So typically where we'll kind of start out as a default is maybe half as a starting point. If you're a very experienced real estate owner and operator, and you have a great track record of investing in real estate over time and managing it and generating returns, that's great. It just has to be a prudent decision by the trust. If it's a prudent decision and it's something that is stable and cash flowing and a valuable asset, we can go up as high as, say, 75%. The trust just has to be managed in a commercially reasonable manner, and in a reasonable manner according to that trustee. So it has to be a good investment, right? Now, if the promissory note that is extended to the taxpayer is, say, 7%, right, annually, and it's doing great with things like treasuries and bonds and things like that, and then you want to take, say, $1 million of that $2 million and put it into a real estate investment. Well, the trust can't just give you that money to put into a real estate investment. There has to be a reason to do it. At the very least, it has to be able to generate enough revenue or potentially gain on the back end, but that's another scenario, to pay the trust enough to make good on its obligation to you. In other words, the trust can't render itself insolvent by entering into an agreement with you to purchase an asset that wasn't suitable for the circumstances of that particular trust. But like I said, the more experienced, the more knowledgeable, and obviously if you're involved with the taxpayer, I'm going to presume that it's going to be someone who's got quite a bit of knowledge, because I know your clientele is generally quite sophisticated in the multifamily market. Obviously a higher amount would be something we'd be more comfortable with.
I got you. Okay, great. That's great insight. It sounds like a pretty great tool for the right situation, and it sounds like we need to talk to our experts, not named Stephen Paulson, but rather Jordan Kanter at Victory Financial Services. Do you do other stuff as well? I mean, I know you were a qualified intermediary. I mean, your resume kind of speaks for itself. Attorney, you've done a lot of things. I mean,
yeah,
like brief understanding of who you are.
Yeah, thank you, Steve. So I think you're being humble. You are quite an expert in your own right, and I do appreciate your excellent questions and your confidence in me to do a presentation like this for your clients. And we've had some great actual calls with people in the past as well. In recent years, I've been primarily doing deferred sales trusts simply because it's really what people have wanted and needed. And we still do 1031 exchanges. In fact, I should mention that a deferred sales trust can be a default from a 1031 exchange, a rescue. So if you want the opportunity to complete a 1031 exchange, you can start it off as a 1031. And then at the end of that 45-day period, if you can't identify anything and your exchange is going to be blown, on day 46, you can rescue that failed exchange into a deferred sales trust. So it gives you 2 bites at the apple. And same thing, if you do identify a property but can't or don't want to close on it by day 180, you can do the same thing. Those are the 2 exit points, day 46 and day 181. I also
so the deferred sales trust option is still alive.
That's right.
All the way through the 1031. And if something hiccups there, you can just execute on the other program and
Yeah.
live to fight another day.
Yeah, the one rub on that is that you have to set the exchange up through us to make sure that you have that opportunity. It's the same cost, same type of 1031 exchange. It's just that we know how to structure these to provide for the deferred sales trust rescue. Sometimes if you're using, a good independent QI, they'll cooperate, but there's no guarantee that they'll really understand or be willing to do it. Many times the institutional QIs are not receptive. So allow us to set up that 1031 exchange for you if possible, and that's something you're thinking of doing. And then you'll have that ability to use the deferred sales trust as a default if you ultimately choose to want to go in that direction. And there's no additional cost for adding that option to the 1031 exchange.
That's very powerful. I got to be honest, because, sometimes we just get hung up on this 1031 stuff, and that is everything for us sometimes. And it's good to know that there's an alternative, number one, and also an opportunity to, if something just doesn't go right, surprises kill deals all the time. And if we get a big surprise, a lot of times it's environmental or, lending issues. I mean, obviously the lending environment's very difficult right now. It's nice to know that there's another path that you can execute on and mitigate some of that risk that you would normally be associating with the disposition of a sale. Because honestly, got a lot of clients who want to trade into something else. Maybe they've got 10 small buildings, they want one big one, but the timing and the coordination, it can be a lot. And so it sounds like the deferred sales trust could be at least a tool worth having a conversation about.
That's right. And as I said earlier, it's not a new or unknown structure. You can find us on the internet. We're out there. We're not hiding from anyone. This has been audited many times. I mean, not so many times that it's an audit trigger. There's only been about 24 audits out of thousands of deferred sales trusts. I'd say that's a pretty minuscule level of audit. So it's not an audit trigger, and it's been 100% successful on audit. So it really is a safe and legal structure to pursue and at least consider for your transaction. And, if the 1031 exchange works out for you, that's great. That's what we want. We want the best result for whoever is engaged in the property sale.
And my understanding too is, as part of the services offering, the estate planning team does defend any sort of IRS issues, correct?
The tax attorney would. Estate planning, yeah. So that's a very good point. So the tax attorney will provide, even though there's a very low incidence of audit, you don't want to be audited and you don't want to have to pay for the defense. So if an audit arises, the tax attorney who structured the deferred sales trust will defend that portion of the audit at no additional cost or expense to the taxpayer.
I see. Got it. Okay. Well, look, I think looking over my notes here, I feel like we've covered quite a lot of ground in a very short amount of time.
Yeah.
Is there anything I haven't thought about?
I don't think so, Steve. I think this was pretty comprehensive and probably more than most people can digest in an hour or so initially. We can always do a follow-up if there's interest. And, of course, as you know, when people have transactions that they're contemplating, we will get the team on the call and discuss their transaction and apply all of this to their particular situation so that it makes sense and there's real numbers being used. And we enjoy doing that. It's always a great conversation and there's no pressure. It's a very easygoing conversation, and we just look to help people achieve the best result that they can. And many of them pursue deferred sales trust quite successfully. And I would encourage folks whose goals fit the structure and the parameters that we discuss will reach out to you. And I appreciate your being such a value-added professional and thinking these things through, because it's not always just a question of who can get you the top dollar for selling your asset. It's who's asking those additional questions to maybe put you in an even better place after the transaction is completed. Are you concerned about the taxes? We want to get you a great price. We want to market your property. But if we can defer your taxes into one of these trusts as well, that's a real home run for you, and something that I know you think about in many respects. I know there's a lot of value-added structures and services that you think about when people are working with you to sell their properties. And I appreciate and respect that. That's obviously why we've been working together for so long.
Yeah, for sure. I've always appreciated, you've always been a huge value add to us and what we do. And, I love having options. I'm definitely an options guy. Like the idea that there's only one mechanic on the planet to, execute on your portfolio goals has always driven me nuts. So I'm really glad that I went down the rabbit hole and came across you. And you're always the utmost professional with my clients and when you talk to them. So we'll certainly, keep sending folks your way. And I appreciate you taking good care of them and taking the time with us today.
One last very simple thing I wanted to mention. Much of what I've talked about today, and perhaps even a little more, is in some very some brief informational brochures that we have that tell you a little bit more about estate planning team and maybe cover a lot of these topics so that people don't have to scramble to take notes or recall everything we said. And if anybody needs or wants those, they should just reach out to you. And obviously, where to reach me if they want to get on a call to discuss a deferred sales trust. And if they want one of those brochures or a schedule of the fees involved or anything like that, we're very open and transparent, and we'd be happy to send those over by email or that's usually the way that it's done, or a printed copy or whatever they'd like.
That sounds awesome. That sounds great.
Yep.
Well, I appreciate the time today, Jordan. I guess we'll see you at the next client meeting.
Yeah, the next episode of the Steve Paulson Show. So I always appreciate you, Steve, and I'll look forward to talking to you again soon.
Thanks so much. Have a great rest of your
Bye-bye.
day.